In this market, we've all heard the names of the legends, the people who made even Wall Street take notice. Today, we're breaking down 10 trading methods tied to 10 iconic figures, strategies that cemented their status as immortal symbols in financial history. Let's get started. 1. Turtle trading. Discipline is the blade that cuts through the market. There are stories on Wall Street that sound like myths, yet they're entirely real. Turtle trading is one of them. A wild experiment, a bet between two of the sharpest minds of their era, and a result that not only created a group of legendary traders, but forged a system that later became the backbone of countless trading firms. Richard Dennis, the Prince of the Pit, once said, "Trading can be taught. You don't need genius. You need rules, and the discipline to follow them." It's a brutal truth for anyone with an oversized ego. We all believe we need high IQ, razor-sharp intuition, or wizard-level chart reading. Dennis proved the opposite. With absolute discipline, an ordinary person can become a money-printing machine. That machine was the turtle. Turtle trading isn't a method, it's a philosophy. People remember turtle trading as a set of entry rules, stop-loss rules, and trend-following rules. But that's only the surface. The real engine, the part that generates the money, is psychology and discipline. Read the turtle rules and you'll think, this is too simple, too easy. You're right, it is simple, but no one can follow it. That is why Dennis chose the name turtle. Slow, steady, unemotional creatures that don't sprint, don't guess, don't jump into markets like maniacs. They move one step at a time and let the market carry them to the finish line. The turtle philosophy: don't predict, react. Losing traders obsess about the future. Will it go up tomorrow? What will this news do? Is this the bottom? Turtles, they don't need to know. If price breaks the 20-day high, buy. If price breaks the 20-day low, sell. No debate, no emotion, no why. It's a slap in the face to any trader with ego, because the strategy requires no macro knowledge, no complex analysis, no forecasting. It only demands you accept one painful truth: you don't know the future, and you don't need to. Turtle trading turns the market into a reaction game. Price moves, you react. Price reverses, you exit. No middle ground, no gray areas, no creative interpretation. That's the power. Turtle's number one weapon: breakouts, but not the amateur kind. Turtle breakouts aren't about chasing big green candles, not about guessing triangle patterns, not about storytelling. Turtle breakouts mean a price level that the market failed to break for 20 or 50 days finally breaks. They bet on this principle. If price breaks a level untouched for weeks, big money is moving. And when big money moves, trends can last months, even years. One small breakout can unlock a massive trend. Turtles don't catch tops or bottoms. They simply hop on a wave that's already formed. Not early, not perfect, just aligned. Sometimes one trend pays for an entire year of small losses. The shocking truth: turtles win not because they analyze better, but because they endure better. Most traders lose because they hate taking losses. Turtles win because they can take dozens of small hits without flinching. They understand a law of markets you must understand too. Big trends happen only a few times a year. But to catch them, you must survive the endless fake signals. Turtles accept that. They know small losses are the price of survival. A stop loss isn't failure, it's capital protection. Every stop is a filter that removes weak signals and preserves strength. They always said, turtles don't die from many small losses. Amateurs die from one big one. That is the line between surviving and blowing up. #turtle money management, the heart of the system. If breakouts are the blade, position sizing is the hand that holds it. Without sizing, you're not disciplined. You're reckless. Turtles divided their capital into risk units, R. Each trade was allowed to lose only one risk unit, never more, and when a trend proved itself, they pyramided, but only under strict control. Strong trend, add. Weak trend, stay out. Turtles only added when price confirmed their direction. Never while losing. Never to rescue a bad position. This alone separates them from amateurs. Amateur, losing, average down, pray for recovery. Turtle, winning, add, because the statistics favor them. Discipline creates the difference. Turtles and market psychology. They treat the market like a wild animal, a beast you can't tame, can't predict, can't control, but you can observe. Turtles don't trade opinions, they trade behavior. If it runs, follow. If it reverses, get out. Don't explain. don't rationalize. This mindset frees them from emotion, the force that destroys 95% of traders. Remember this if you want to understand turtle psychology. The market doesn't care who you are. It rewards discipline and punishes emotion. Wall Street loves complexity. Turtles love simplicity. Wall Street worships math geniuses and macro profits. But history shows that the longest-lasting traders are often the ones with systems as simple as the turtles. Markets don't reward intelligence. They reward rule following. The turtle method destroys two illusions. You don't need to predict to make money. You just need to react fast enough. You don't need a high win rate. You just need one big winner to pay for many small losers. Most traders will never accept this. The hardest part of turtle trading isn't the system, it's you. The turtle rules fit on a single sheet of paper, but you won't follow them. Why? You'll think the breakout is too late. You'll feel the trend has gone too far. You'll be scared of buying the high. You'll get frustrated after a few stopouts. You'll try to optimize the rules. At that moment, you're no longer a turtle. You're just another emotional trader. Turtles survive because they treat discipline as a weapon, not inspiration, not intuition, not "I think the market will do this." Discipline is the blade that cuts the market for them. Clean, precise, cold. Who is turtle trading for? Not for people who want quick wins, not for people who hate losses, not for people who need constant action. It's for those who accept simplicity, see trading as probability, not prediction. Understand that a few small losses don't matter compared to one big trend, are cold-blooded enough to follow rules like a machine. If you can become that kind of person, turtle trading can turn a losing trader into a long-term survivor. If you can't, the market will remove you like everyone else. Conclusion. Turtle trading isn't a fairy tale. It's a survival manual for a world that devours most people who enter it. If you start your trading journey chasing fast wins, you'll die fast. But if you take the turtle path, slow, steady, small losses, big trends, you'll join the rare group of traders who understand one simple truth. The market doesn't need you to be smart. It needs you to be disciplined. 2. Price action. Jesse Livermore. Read the flow of money, not the desires in your head. Some people aren't born to get rich. They're born to see the market in a way the rest of the world never could. Jesse Livermore was one of those people. No computers, no indicators, no algorithms. What he had was the tape, the flow of money, and a mind quiet enough to hear what the market was actually saying. Livermore didn't trade charts the way we see them today. He traded price behavior. He read the intentions of big money. He analyzed how the crowd reacted. And ultimately, he won because of a skill most modern traders have lost: the ability to read pure price action in its original form. Livermore didn't see the market as a chart. He saw it as a story. While most traders stare at red and green candles like lifeless data, Livermore saw who's buying, who's selling, who's trapped, who's panicking, who's hunting liquidity, and most importantly, where the flow of money is exposed. Candles weren't patterns. Candles were human reactions under financial pressure. That's why he often said, the market doesn't move because of news. It moves because of how people react to the news. This distinction made Livermore's price action sharper than any indicator ever could be. Core philosophy: don't read your desires, read the strength of money flowing through the market. Traders lose because they look at charts to find what they want to see. Looks bullish, probably reversing. This pattern is perfect. Livermore didn't search for anything. He simply observed. He removed his ego from the chart. He let the flow of money tell the story. If the money was strong, he followed. If it was weak, he stepped aside. If it was silent, he waited. And here's what very few understand. Livermore didn't trade trends. He traded the psychology behind trends. The method: Livermore's 3 layers of reading price action. He broke the market into 3 layers: signal, test, confirmation. These layers later became foundations for many modern price action schools. Let's go through them. 1. Signal. The market hints at its intentions. This is where price behavior becomes unusual. Price rises but volume doesn't follow. Price drops but gets bought up aggressively. A level that used to be heavily defended suddenly turns quiet. Price stalls for an unusually long time. Volatility compresses like a wound-up spring. Livermore called these the footprints of big money. He didn't enter on the signal. He simply noted, someone is preparing to do something big. 2. Test. The market checks the weakness of the losing side. Big money doesn't trade like retail. They test the market, retest the lows, push the price down to check if buyers remain, push it up to see if sellers still exist, shake out weak traders with a minor stop run, create traps to separate weak hands from strong hands. Livermore always waited for the test. If the test succeeded, meaning weak hands were removed and strong hands held, he knew powerful money was preparing to move the market far. This is one of the secrets he used to avoid noise and false moves. Number 3, confirmation. When price action reveals the truth, Livermore never entered when the market was unclear. He entered only when price confirmed the real direction. Breaking key structure, breaking out from long consolidation holding trend, despite tests the opposing side being squeezed, unable to fight back. He waited for the moment the market could no longer hide. This patience is why Livermore became rich, while others blew up. Livermore's entry: not early, not late, exactly on time. Amateurs enter from impatience. Livermore entered because the market allowed it. He had 2 primary entries. 1, pivot point, the psychological turning point. He didn't call it what modern traders call it. He called it the point where the market reveals its true intention. It's where weak hands give up, strong hands dominate. The breakout is no longer noise. The retest is no longer a trap. At the pivot, he entered decisively because it wasn't guessing anymore. It was following money. 2, continuation entry, entering after the market proves its strength. He never tried to catch bottoms or tops. He entered only when the trend proved its power. A strong candle breaking a barrier, a weak pullback quickly bought up a sell-off, losing momentum. That's how he jumped on the train without fear of chasing. Livermore's stop loss: cold and surgical. While most traders fear stop losses, Livermore treated them like mandatory insurance. He often said, being wrong is normal. Refusing to cut losses is the disaster. His stop loss wasn't emotional. It was structural. If the pivot breaks, he's wrong. If the test fails, big money isn't supporting. If price behavior turns abnormal, something has changed. What made him different wasn't where he cut, but how fast he cut. He exited so quickly, most traders wouldn't even react in time. His trend philosophy: no one gets rich predicting, they get rich waiting. Livermore mastered patience. He never rushed to take profits. He understood the market's timeless rule: big trends pay for all small mistakes. When he was right, he didn't touch the trade. He didn't look for a target. He simply trailed based on price action. He let the money flow guide him. He let the market decide when the trend was over. This alone separated him from 90% of modern traders. Not because it's hard, but because they lack patience. Livermore's candle reading: not patterns, but the psychology inside them. Modern traders love patterns: pin bars, engulfings, inside bars. Livermore needed none of that. He looked at a long candle. Someone is pressing hard. A short candle. Market hesitation. Long wicks. Fierce battle. Weak bullish candles after a strong drop. Buyers exhausted. Weak selling at new highs. Sellers lack conviction. He read candles the way a poker player reads faces. Not the shape, but the intention. Livermore versus the crowd. Where he made the most money. He didn't just trade the market. He traded human behavior. He knew the crowd. Loves buying after big moves, sells in panic, tries to catch bottoms because it's cheap, hates waiting, hates cutting losses, hates admitting mistakes. He exploited each weakness. When the crowd panicked, he stayed out. When they were greedy, he prepared to sell. When they were doubtful, he built positions. When they were patient, he waited for them to crack. This is why price action in his hands wasn't a tool. It was a psychological radar. The difference between Livermore's price action and modern traders: many study price action to find patterns. Livermore studied price action to understand people. That's why. Traders study PA, but still lose. They memorize patterns, but still get trapped. They see signals, but ignore money flow. They see charts, but miss psychology. Livermore didn't look at what the market drew. He looked at what the market felt. And that's something computers can never replace. Conclusion: Livermore's price action is art, but art built on steel discipline. His price action wasn't analysis. It was observation, not prediction, reaction, not beating the crowd, understanding it. He didn't search for patterns. He searched for behavior, not for contrarian opportunities, for exposed money, not for perfection, for truth. And the greatest truth he left behind for financial history is, don't read your desires, read the money. That is the core of price action and the reason Jesse Livermore became a legend forever. 3. Richard Wyckoff, the invisible market maker whose footprints still shape the charts. In every phase of the market, there's always an unseen force at work. They don't show their accounts. They don't reveal their entries. They don't share their strategies. They only leave footprints. And Richard Wyckoff was the first person bold, patient, and sharp enough to trace them. While most traders try to guess whether the market will rise or fall, Wyckoff asked a completely different question. Who's buying? Who's selling? And why? To Wyckoff, the market wasn't a charting game. It was a negotiation of power. You're not trading price. You're trading the behavior of the entity that controls price. And that entity is the market maker. Wyckoff viewed the market like a hunt timer. You've seen price crawl sideways for hours, then explode out of nowhere. You've seen picture-perfect breakouts instantly reverse and wipe out inexperienced traders. You've seen a silent market suddenly deliver a knockout punch that vaporizes millions in minutes. Wyckoff said, none of that is random. Those are the footprints of the operator. They accumulate, they distribute, they suppress price, they lift price, they trap the crowd, they make traders feel confident right before the market proves they were just prey. A normal trader sees candles. Wyckoff sees intention. Wyckoff's method starts with one brutal truth. Market makers never chase price. They create price. They need to buy massive size, but they cannot buy all at once or price will spike. They need to sell massive size, but they cannot dump it or price will collapse too early. So they must build a zone, an accumulation zone, a distribution zone, a place where they can load or unload without alerting the crowd. That's where Wyckoff stepped in and exposed their entire operation. 1. Accumulation, where the market maker becomes the patient predator. During accumulation, the crowd sees a boring range, no signals, no action, nothing interesting. Wyckoff saw the opposite. He knew the operator was eating supply piece by piece. They accumulate quietly. Each dip gets absorbed. Each minor panic is bought. Each little sell-off is swallowed. Wyckoff called it absorption. The market maker makes the crowd believe the market is weak, so they sell, and he buys all of it. Accumulation is psychological engineering. Wyckoff's rule here is simple. Don't watch price. Watch how price reacts to selling. If heavy selling no longer pushes price down, there's only one explanation. A bigger buyer is supporting the market. The breakout is not the entry. It's confirmation the operator is ready to move mass. The crowd buys the breakout. Wyckoff never does. He knows a breakout is merely the consequence of a completed accumulation. Strong breakouts mean supply is gone. The operator only pushes after loading up. Wyckoff wrote, when supply is exhausted, even a small amount of demand can lift the market sharply. To traders, that's a signal. To Wyckoff, it's the logical result of the operator's work. 3. Distribution, where the market maker becomes a master illusionist. If accumulation is stealthy, buying in the dark, distribution is elegant, selling in broad daylight while the crowd cheers. During distribution, the trend looks strong. News is positive. Influencers are bullish. Retail is euphoric. But Wyckoff sees what others can't. He sees hidden selling pressure, fake pumps, volume on red bars, price hesitating under selling. The operator is no longer stimulating demand. He's unloading into it. He sells when the crowd buys. He sells on good news. He sells while everyone knows the market will go higher. Wyckoff said the operator always sells before the public realizes they should. 4. Spring, the perfect trap. One of the operator's classic signatures, the spring. Price breaks the range to the downside, triggering stop losses. The crowd panics and dumps everything. The operator absorbs it all at a discount. Moments later, price launches upward. The crowd watches in rage. Why did it sweep my stop and then pump? Wyckoff answers calmly, because your stop loss was the liquidity they needed. Springs aren't random flushes. They're the trigger of a long-prepared plan. 5. Sign of strength. The market maker confirms the move. When price breaks above the range with strong volume, Wyckoff calls it the sign of strength. It means the operator is done accumulating. Supply is absorbed. The real move is beginning. This isn't a late entry. It's validation that you're aligned with the smart money. Wyckoff never taught traders to pick tops or bottoms. He taught them to follow the dominant force. Wyckoff's philosophy: if you don't understand the operator, you're prey. Most traders lose because they trade on emotion, belief, or hope. Wyckoff did none of that. He analyzed the market like a crime scene. Who's applying pressure? Who's absorbing? Who's accumulating? Who's distributing? Who's setting the trap? He knew price is simply the output of a supply-demand battle, and the operator holds most of the leverage. Wyckoff didn't teach prediction. He taught deduction. Not where will price go, but what are buyers and sellers revealing about their strength? Not what candle is this, but who created it and why? Not will the market go up, but has the operator finished their plan? Why Wyckoff's method remains timeless. Technology evolves, markets evolve, but human nature and the behavior of big money do not. Operators used to place orders manually. Now they use algorithms and supercomputers. But their goals haven't changed. Buy cheap, sell high, hide their intentions. Accumulation is still accumulation. Distribution is still distribution. Traps are still traps. Absorption is still absorption. The footprints change shape. The logic does not. Wyckoff didn't give you a formula. He gave you sight. The sight to see through the noise, to detect the major player, to separate traps from true opportunity. Conclusion: traders don't lose because they can't analyze. They lose because they don't know who controls the market. Wyckoff left a legacy. Read the footprints of big money. Don't chase price. Don't chase news. Don't chase the crowd. If turtle trading teaches discipline and Livermore teaches you to read money through price behavior, then Wyckoff teaches you to read the mind of the one who controls the market. The market maker never shows his face. He only leaves clues. With Wyckoff's method, you become the tracker. When you understand him, you no longer trade candles. You trade the intentions behind them. That's the only way to survive long-term in this market. 4. Al Brooks, pure price action, ridding the market's every breath. There are methods that help you see the market's big picture. There are systems that give you a rule book. There are philosophies that help you understand the crowd behind the price. But Al Brooks chose a different path. He doesn't rely on legends. He doesn't look at indicators. He doesn't need reputation. He focuses on the rawest, most primitive, most unforgiving element of the market: price. Unfiltered, unpolished, unmasked. To Al Brooks, every candle is a battle, a clash, a tug of war between buyers and sellers. And if you're sharp enough, patient enough, disciplined enough, you can hear the market breathe through each fluctuation. Al Brooks doesn't turn the market into art. He turns it into anatomy. If Wyckoff reads the footprints of market makers, Al Brooks reads the smallest muscular twitch of price. He doesn't see charts as music. He sees them as the ECG of capital flows, the heartbeat of the market. While most traders look at charts from a distance hoping to find patterns, Al Brooks zooms in and asks the only question that matters. On this candle, who's winning? Not in the trend, not in the pattern, not in the indicators. But in this moment, is buying pressure or selling pressure in control? That simple question changed how he trades forever. 1. The market is always in one of 3 states, and only 3 Brooks eliminates the unnecessary complexity traders create for themselves. He says the market only has 3 states: trend, trading range, breakout, or failure. Just 3, not 4, not 10, not the fancy terms traders invent to feel smart. He understands this truth. Once you know the market's state, you know what to do, or when to stay out. Trend, you follow. Range, you wait. Breakout, you trade the decision of capital flows. The challenge isn't labeling the state. It's recognizing the early signals when everything is still unclear. That's where pure price action shines. 2. Every candle is a vote. Brooks doesn't see candles as patterns. He sees them as evidence. Each candle is a vote. Buyers want to lift the market. Sellers want to push it down. Body, strength. Wick, hesitation. Volume, not critical, because everything is already in price. Brooks doesn't seek answers in the outcome. He studies the process. He doesn't ask, is this candle bullish or bearish? He asks, how did it move? Under what conditions did it form? Who's bleeding? Who's in control? That's the difference between reading candles and reading the market. 3. Pullbacks are the exam that proves whether a trend is real. Most traders fear pullbacks. Brooks treats them like a diagnostic test. A real trend has shallow pullbacks. A weak trend has messy, expanding ones. In an uptrend, if pullbacks grow, the trend is tiring. If pullbacks shrink, buyers have absolute dominance. If pullbacks are shallow but volume rises, sellers are fighting back. He teaches you to read a pullback the way a doctor reads a patient. Is there weakness? Is the trend healthy? Is the heartbeat irregular? Understand pullbacks, understand the market's breathing, and you'll know a trend is ending long before others see it. 4. A breakout matters far less than the follow-through. Everyone likes a big breakout. Everyone gets excited by the long candle. Brooks stays cold. He doesn't trust breakouts. He trusts the reaction after the breakout. Strong breakout with weak follow-through, fake. Small breakout with strong follow-through, real. He says, the market speaks through the second action, not the first. Traders lose because they buy the appearance. Brooks buys the underlying force, something that can't be faked. That's the difference between a losing trader and a professional. 5. Inside bars and tight channels reveal who's planning their next move. An inside bar isn't a pattern. It's dangerous silence. Brooks says, when the market goes quiet, someone is planning a move. If silence lasts too long, a strong trend is brewing. If silence follows a major trend, the opposing side is preparing to strike. A tight channel is the signature of a trend with intent, the winning side suffocating the losing side. No deep pullbacks, no wide pauses. When you see a tight channel, you don't go against it. You ride it. 6. Brooks doesn't trade to predict. He trades to follow rising probabilities. A key part of his philosophy, price isn't something you forecast. Price is something you respond to. He sees the market as a negotiation of forces. Each signal is a piece of data. Each piece shifts probability. Probability low, stay out. Probability modest, enter small. Probability overwhelming, size up. He doesn't teach perfection. He teaches rational probability. 7. The market is never wrong. Only traders tell themselves the wrong story. Traders lose because they create narratives. Price must go up. This level has to hold. This breakout is real. This trend can't fail. Brooks destroys these illusions. He says the market doesn't care about your story. It only cares who's willing to pay more. Meaning, don't attach emotions. Don't guess. Don't defend your analysis. Observe, react, correct quickly. That's true price action. 8. The difficulty of Brooks' price action is exactly what makes it dangerous. No indicators, no pretty signals, no colored curves, no holy grail patterns. Only price, structure, momentum, shifts in buying and selling pressure. To the untrained eye, his approach feels like a foreign language. Once you understand it, you realize the chart is speaking, the market is narrating, the candles are breathing. Prediction becomes unnecessary. You simply read what's happening, like reading a pulse. 9. Brooks doesn't teach you to read candles. He teaches you to read the market as a living organism. He brings you to a level of detail few dare explore. The breath, the heartbeat, the impulses, the micro shifts of strength between buyers and sellers. If the turtles focus on discipline, if Livermore focused on money flow, if Wyckoff focused on intent, Brooks focuses on the purest signal of all, the movement of price in each moment. He teaches, price always tells the truth. You just haven't learned its language yet. And once you do, you'll never see the market the same way again. 5. Volume profile and value areas. Big money can't hide across every market. Stocks, Forex, futures. There is one iron law amateur traders overlook. Big money can't hide. You can stay anonymous. You can use algorithms. You can spread misleading news. But when capital moves, it leaves behind a physical footprint. That footprint lives inside the volume profile, the map of traded volume, and the value area, the zone professionals use to track the movements of institutional money. Volume profile isn't just a chart. It's a survival map, showing who's strong, who's weak, and where the market is about to explode. 1. Big money never moves alone. Retail traders think, maybe price goes up? Let's jump in. But big money doesn't operate that way. A hedge fund can't buy 1 million shares in one session without sending price vertical. They must. Distribute orders. Control the average execution price. Absorb supply without causing panic. When they do this, volume spikes, price moves slowly, and the prices where they transact the most appear clearly on the volume profile. That region is the value area. And inside it, big money shows its hand, even without showing its face. 2. Understanding volume profile. Knowing who holds power. Volume profile organizes price by volume, not time. It answers critical questions. Which price traded the most? Where buyers and sellers agreed. Which price is absorbing orders? Where institutions are in control. Which price shows little activity? A volatile zone likely to break. Amateurs watch candles and trends. Professionals watch where big money positions itself. Price near the value area, equilibrium, stand aside or probe. Price far from the value area, likely reversion or a strong breakout. Price breaking the value area, follow institutional flows, not feelings. Volume profile doesn't speak to your emotions, it speaks to the market's true strength. 3. The value area, where the strong hands operate. Wyckoff taught accumulation and distribution. Volume profile reveals exactly where market makers accumulate or unload. Value area highest price institutions accept value area low. Val, lowest price they're willing to buy. Point of control, POC, the price with the highest volume, the heart of the flow. Price inside the value area, balanced market. Price outside the value area, big money is taking control. Price can mislead. Volume tells the truth. 4. The footprints of big money, accumulation and distribution. Volume profile exposes what Wyckoff described. Accumulation, high volume, sideways movement, institutions quietly loading up. Distribution, rising volume near highs, institutions unloading while the crowd is euphoric. Candles alone can't show this. Volume profile reveals the exact zones where they act, helping traders follow, not get trapped. 5. Entry signals using volume profile. Follow the footprints, not the predictions. Retail traders guess tops and bottoms. Professionals follow actual transactional strength. Price near POC test the forces. If big money supports it, enter price breaking VAL or VAH, follow the breakout with institutions. Price pulling away from value, stay out or wait for the pullback. Volume profile helps you act based on probability, not emotion. 6. The principle. Big money always leaves a trace. Every major move requires liquidity. No liquidity, no large trade. Institutions can't move alone. Every institutional action shakes candles, pushes volume, creates a high-activity price zone. Volume profile only needs a trained eye to identify it. Retail traders fall for breakout traps and stop hunts because they don't see value areas. Professionals see who controls the game and act accordingly. 7. Combining price action with volume profile. Price action gives you rhythm. Volume profile gives you weight and intention. Together, a strong candle with a volume spike at POC confirms trend strength. A breakout above or below the value area with solid price action, high probability move. Price returning to VAL with rejection candles, safe, asymmetric entry. No prediction, no hope, only reading the evidence. 8. The survival lesson. Big money can't hide. Great traders don't rely on news, emotions, or pretty chart patterns. They follow the footprints of those who truly move the market. Who's in control? Who's absorbing or distributing? Which price levels institutions refuse to ignore? Once you answer these 3 questions, you stop being the one who gets hunted and become the one who follows the strongest flow. 9. Volume profile is the language of big money. It's cold. It's ruthless. It won't wait for you to understand. But once you learn to read it, you'll see. Big money never hides. It always leaves a trail, visible to those who know where to look. The value area is the map. Volume is the lens. Price action is the ear listening to the market's heartbeat. Master all 3, and you stop guessing. You start tracking institutional footprints. 6. Tudor Jones. Failing to protect capital is suicide. In the trading world, the truth is simple but brutal. Fail to protect your capital, and you're committing suicide. And no one delivers that reminder more sharply than Tudor Jones. Tudor Jones, famous for calling the 1987 crash, didn't become a legend by predicting the market. He became one by protecting his capital first, long before thinking about profits. In his philosophy, survival matters more than being right a few times or hitting a big trade. If you're wiped out, you don't get another chance. It sounds obvious, yet very few traders truly understand it. 1. Capital preservation mindset. Survival comes before everything. Jones teaches, I don't care how much you make if you don't have enough left to stay in the game. Amateur traders dream about profits. I'm going to make 10% today. I just need a few quick scalps to grow my account. But the market doesn't care about your dreams. One stop hunt and your entire starting capital is gone. Lose your capital, you're out of the game. Capital preservation isn't a technique. It's a survival mindset. a fundamental law. Before taking a trade, Jones asks, if I'm wrong, how much will I lose? Will I still have enough to keep playing? If the answer is no, he doesn't take the trade. 2. Stop loss, not optional. It's iron discipline. Inexperienced traders see stop loss as a burden. Jones sees it as a survival weapon. He sets his stop before the market moves. No emotional adjustments, no wishful thinking, no hoping the market turns back. To Jones, a stop loss is survival insurance, maximum risk control, non-negotiable discipline. He once said, "What scares me isn't the market going against me. What scares me is failing to stop in time and losing everything." 3. Controlled risk. Only bet what you can afford to lose. Jones never goes all in on a single idea. He sizes small, tests the trend, and only scales when he's right. Start small to probe the market. If right, add gradually, pyramiding. If wrong, cut immediately, no hesitation. This blend of discipline, risk management, and mental toughness creates longevity. Amateurs add to losing trades. Jones calls that financial suicide. 4. Crisis lessons. Profit is secondary. Survival comes first. In the 1987 crash, many traders were wiped out by greed and lack of discipline. Jones survived not because he predicted perfectly, but because he protected aggressively. He stopped out early, stayed out when the trend was unclear, and only re-entered when probabilities favored him. He summed it up coldly. If you don't survive, you can't win. If you don't protect capital, you're killing yourself. 5. Psychology plus technique. Survival is the first victory. Capital protection isn't just technical. It's psychological. Don't let greed lead. Don't let fear blind you to risk. Don't let belief turn into delusion. Jones treats trading like a mental war. Only those who survive long enough can win. Every strategy, indicator, or signal becomes useless if your capital is gone. 6. Survival principles for every trade. Survive first, capital protection is law. Discipline is the weapon. Stops must be firm. Risk must be measured. Never bet everything. Be patient and decisive. Cut fast when wrong. Pyramid when right. Steal strong psychology. Emotions never dictate decisions. Forget these rules and nothing else matters. Not trend following, not price action, not volume. Nothing can save you once your capital is erased. 7. Paul Tudor Jones, a lesson for modern traders. In the era of robots and algorithms, Jones' principles remain intact. Technology can boost profits, but without capital protection, you'll exit the game even faster. Smart traders don't try to win every trade. Smart traders try to survive long enough to win the trades that matter. 7. George Soros. Being wrong is fine. Staying wrong is disaster. In trading, one of the harshest truths is this: being wrong is inevitable. Staying wrong is catastrophic. George Soros, the man who broke the Bank of England, never feared being wrong. He feared only one thing: being wrong and refusing to stop. Soros openly admits he makes money because he knows when he's wrong and reverses immediately. In his philosophy, losing fast and winning slow is the ultimate survival rule. 1. Being wrong isn't the problem. Staying wrong is what kills you. Amateur traders make one fatal mistake. They don't lose because they're wrong. They lose because they refuse to admit they're wrong. They cling to hope. The price will come back. They add to losers, trying to recover. Soros views it coldly. Being wrong is normal. Staying wrong destroys every opportunity you have ahead. Being wrong is information. Being wrong is a signal. It only becomes deadly when you refuse to act. 2. Reflexivity, Soros's classic principle. His famous reflexivity theory states, markets don't just reflect reality. Markets shape reality. Prices and trader perceptions influence each other, creating self-reinforcing distortions. When the crowd gets euphoric, prices overshoot. When the crowd panics, prices undershoot. Soros doesn't try to predict fair value. He watches distortions and strikes at the right moment. Being wrong is normal. Staying wrong makes your capital evaporate. 3. Instant cutting of losses, his ultimate weapon. One of Soros's core principles: cut losses fast and reverse the moment you realize you're wrong. He says, I'm rich because I know when I'm wrong. I'm not rich because I'm right all the time. Wrong trade, cut immediately. Capital intact, next opportunity remains. Right trade, add to it, ride the momentum. That's how he turns losses into opportunities. No stop, slow death. Quick stop, survival and compounding. 4. Size and timing. Small, when unsure, big when the odds favor you. Soros respects risk to the extreme. Enter small when the signal is unclear. Scale up only when money flow confirms the trend. Exit instantly at the first sign of being wrong. This philosophy kept him alive through countless shocks. Amateurs scale into losers and blow up. Soros survives because he's wrong fast and wrong small. 5. Psychology. Ego is the enemy. Average traders die by their ego. They refuse to admit mistakes. They try to prove they're right. They let fear and greed run the show. Soros sees the market as an intellectual game, not a stage for ego. Wrong, no shame. Right, no arrogance. Focus always, probability and risk. Ego is the real enemy. The market is only the test. Those who win are the ones who manage their ego first. 6. Follow the money flow. Don't predict, react. Soros doesn't try to call tops or bottoms. He watches where the money is actually moving. Volume, order pressure, market reactions. Price deviations, reversal potential. Market signals, trade probabilities. Wrong, learn from it. Stay wrong, lose both money and opportunity. That's how he turns losses into data and data into profit. 7. A lesson for modern traders. Being wrong is normal. Don't fear it. Staying wrong is fatal. Cut losses fast. Reverse when needed. Trade based on probability, not emotion. Ego is the enemy. The market is the exam. If you absorb Soros' philosophy, you'll see losing isn't failure. Staying wrong, that's the real disaster. 8. Mark Minervini. Entry must be as sharp as a surgical knife. In trading, there are 2 ways to die. Enter too early. The market sweeps your capital. Enter too late. You miss opportunities and trade ineffectively. Mark Minervini, stock trading champion, understands this deeply. He doesn't just teach how to pick good stocks. He teaches how to enter at the right moment, at the precise price, with the precision of a surgical knife. For Minervini, entry is everything. A sharp entry not only increases your probability of winning, but also minimizes risk. If your entry isn't precise, the market punishes you instantly. 1. Entry is technique, not emotion. Amateur traders enter based on feelings. I feel the price will go up. I missed the peak. I have to jump in. Minervini shatters this illusion. Entry must be based on data, charts, patterns, and volume, not gut feelings. Price must break out properly. Volume must confirm strength. The overall market must support. All factors must align. Enter only when the probability of success is high. 2. Seamless entry. Let the market rhythm guide you. Minervini emphasizes, entering at the right time means understanding the market's rhythm. No rush. No hesitation, no guessing tops or bottoms. Breakout entry, pullback to support entry. Tight base formation complete entry. Each entry is a breath of the market. If you understand that rhythm, you enter as a natural part of price movement. 3. Stop loss immediately. Discipline is key. A sharp entry without a stop loss is useless. Minervini places a stop loss immediately to protect capital. Correct entry, tight stop, low risk. Wrong entry, cut immediately, survival. No delays, no hope, no wishful thinking. A sharp entry must be paired with iron discipline to survive harsh markets. 4. Proper size. Don't risk your whole capital. Minervini stresses, a sharp entry requires the correct position size. Too big, stress if winning, disaster if losing. Too small, missed opportunity. The right size is calculated relative to stop loss. How much can you afford to lose if the entry fails? That's the formula for precise sizing. 5. Ready to act, but never rushed. Minervini teaches traders to be ready to act at any time, but only when conditions are perfect. Watch the daily chart. Monitor volume, breakout, tight base. Be prepared, but never impulsive. Entry is a combination of emotional control and probabilistic reaction. All conditions align, press the button. If not, stand aside. 6. Sharp entry, maximum profit, minimum risk. A sharp entry helps you reduce risk, tight stop, small loss. Maximize profit, ride the trend from the start, full gain. Increase winning probability, multiple factors aligned. Amateurs trade carelessly, wide stops, big losses, or enter late, small gains. Minervini teaches, entry must be as precise as a surgical knife, cutting losses and seizing opportunities. 7. Psychology. No fear, no greed. Amateurs fear missing out, enter late, sloppy trades. Amateurs are greedy, hold wrong trades, lose capital. Minervini teaches, if entry conditions aren't met, stay out. If entry conditions are met, act decisively. It's the balance of patience and quick reaction between fear of missing out and fear of loss. 8. Integration with overall strategy. Minervini's sharp entry doesn't stand alone. Stock selection, pick strong assets, market rhythm. Track trends, pullbacks, breakouts, capital management, size stop loss, minimize risk. Steal mindset. Act only when all conditions align. Only when all factors align, entry is truly as sharp as a surgical knife. Follow the method, survive and profit long term. Ignore it, the market will make you pay. 9. Market wizard mindset. Systems are not for prediction, they are for survival. In trading legend, people often misunderstand. A good system is one that predicts the market. But market wizards from Ed Seykota, Marty Schwartz to Richard Dennis know a harsh truth. A system is not for prediction. It's for survival. Amateur traders dream of big profits, guessing tops and bottoms, hoping the market helps them. Legendary traders focus on probability, risk management, and discipline to survive long enough until the odds tilt in their favor. 1. Survival comes before winning. Market wizard mindset starts with a simple but cold principle. If you die, you can't win. Amateur traders overtrade when losing, blow up accounts. Amateur traders try to predict trends, get stopped out. Legendary traders survive with the system. The system isn't for 100% accurate predictions. It's to maximize survival, minimize losses, and act according to probability. 2. Probability and statistics, the market's language. A good system knows winning trades only happen 50-60% of the time. Losing trades are information, not personal failure. Long-term results determine success. Market wizards don't judge success by single trades. They watch sequences, statistics, adjust systems based on probability, risk, reward, and win-loss frequency. Wrong, learn from stats. Right, add on when odds favor you. This separates dreaming amateurs from legendary traders. 3. System, discipline plus survival. A real trading system doesn't need to be complicated. It needs clear entry rules. Entry, stop loss, pyramid and capital management. Proper size, measured risk. Steal discipline. Follow rules even when emotions spike. Break rules, system fails. Follow rules, survive and win long term. Market wizard mindset. The system can't save you if you break discipline. 4. Don't predict. React to reality. Amateurs try to guess bottoms and tops. Trust gut feelings. Legendary traders know predicting is a suicide game. A good system does 3 things. Observe the market. Price action, volume, trend. Identify signals by rules. Entry, exit, stop. Act according to probability. Scale in when right, cut when wrong. You don't need to guess. Just react to what the market is doing using system signals. 5. Losing is information, not failure. One secret of market wizard mindset. Every losing trade is data, not guilt. Winning trade, system confirmation. Losing trade, check, adjust. Losing streak, learn survival. Amateurs feel losses personally. Panic, overtrade. Die early legends manage losing streaks, survive, win long term. 6. Survival equals opportunity to compound gains. Market wizard mindset treats survival as the prerequisite for profit. If you survive, you can scale in when odds favor you. If you die, profits are meaningless. That's why legendary traders prioritize risk management and stop loss above all before thinking of gains. 7. Psychology. No desire, just action. Amateurs often want to guess right, want to win every trade, want quick money. Legends, no desire, just observe. No greed, just follow probability. No fear, just follow the rules. A system isn't magic, it's a survival machine, keeping emotions out of decisions. 8. Survival philosophy. Market wizard mindset. Mistakes are normal, staying wrong too long kills you. The system is a survival tool, not a prediction engine. Capital management and stop loss are non-negotiable. Losing streaks are data, not personal failure. Probability plus discipline equals survival, long-term success. Understand this, and you'll see, legends aren't those who guess right most often. They are those who survive long enough to win when the odds favor them. 9. Conclusion. Systems are for survival, not prediction. Market wizard mindset changes how traders see the market. Being wrong isn't critical, surviving is. The system is not prediction, it's action by probability. Risk management and discipline, keys to survival. Losing streaks, data, not guilt. Apply this mindset, survive, learn, and gradually turn probability into profit. Amateurs guess, legends react. Survival is step 1. Long-term winning is the natural outcome. 10. Jim Simons and Renaissance Fund. Algorithms on the market, data never lies. In the trading world, most traders believe experience, instinct, and gut feelings are the keys to success. Jim Simons, founder of Renaissance Technologies, shatters that notion. Data never lies. Algorithms never tire. Humans always err. If you think trading is a game of emotion and prediction, look at Simon's. He hires mathematicians, physicists, programmers, not traditional finance experts. The Medallion Fund, an algorithmic marvel, earns hundreds of percent annually. Every decision is based on patterns, probability, and data, not emotions. A simple but ruthless philosophy. If data points one way, don't listen to your heart. Listen to the data. 1. Data is the only truth. Amateurs trust feelings, trust market intuition. Simon's trusts data, volume, price, spread, historical volatility, repeating patterns, signals hidden in noise. Probability based on numbers, systematized. Data doesn't hide, lie, or feel. Respect data, act precisely. Ignore data, die or miss opportunities. 2. Algorithms equals precision plus absolute patience. The Medallion Fund doesn't rely on emotion, no hoping prices rise or fall. Algorithms analyze millions of variables, detect recurring patterns invisible to human eyes. Pattern appears, act. Pattern disappears, stop. No greed, no fear, no hesitation. Every trade is probability-based, minimal risk, maximum profit. 3. Humans are the limiting factor. Algorithms are the solution. Simons understands a harsh Wall Street truth. Human traders tire, let emotions rule, make mistakes. The market never sleeps, never waits. Solution: automate, systematize, trade patterns. Robots don't fear losses. Don't get greedy. Don't regret. Humans supervise algorithms. Avoid emotional interference. That's why the Medallion Fund profits consistently, while even the best human traders sometimes blow up. 4. Absolute risk management. Even data-driven, Simons never ignores risk. Position sizing. Each trade occupies only a small portion of capital. Automatic cut loss protects capital from sudden swings. Algorithmic diversification. Multiple strategies, markets, timeframes. Systems and data maximize profits, but risk management is the survival foundation. 5. Patience and repetition. Amateurs get frustrated after 1 to 2 losses. Simons knows algorithms profit over the long term, not single trades. The system executes millions of small signals. Profit comes from cumulative signals and probability. Traders only need discipline and let the system run. Patience is part of the strategy. Data plus algorithm patience equals extraordinary returns. 6. Psychology. No emotion, only probability. A human trader often gets excited when winning, overtrades, panics when losing, cuts too early. Simons teaches, no emotion, act according to probability. Pattern correct, trade, pattern wrong, stop. No hope, no greed, no regret. That is the market doesn't care about you, data does mindset. 7. Lesson for modern traders. Trust the data, not your feelings. The system is a weapon, not a prediction tool. Discipline plus patience equals survival and long-term profit. Humans are limiting. Use algorithms to exploit patterns. Risk must be absolutely managed, even with good data. Understand this philosophy, and you'll see. Legendary traders are not those who guess right most often. Legendary traders are those who follow data, systems, and discipline long enough for probability to work. If you see value in this series, if you want to keep learning real Wall Street philosophies, hands-on trading psychology, lessons with no fluff, no sugarcoating, if you want to understand how the market truly operates, not the stories you see on social media, subscribe to Trading Mindset Lab.